Hey everybody, welcome to today's video. My name is David. Today's topic is about how to double your assets without using double the capital. This is a very interesting topic, especially for business owners, because as a business owner, you might be flush with cash in your corporation and you're trying to figure out how to maximize your investment potential using that capital without actually creating any undue strain with your operating capital, but also reducing taxation. So often, as we're going to get into this subject, and by the way, I'm not going to be going through any tables, no calculations. This is just talking about one single strategy, very easy to follow along and won't be a long video. I really want you to examine this strategy on its merits and just think about how that might apply to you, and then go on up to this videos and you're going to see more in-depth coverage as to how to actually implement this type of strategy in your own situation. So why don't we get into this right away? Okay, you having cash in your corporation, as you well know, doesn't help your corporation. Beyond the fact that whatever you need to maintain your operations, that's important, but the excess capital that you have in your corporation is just sitting there as cash, and I like to say, rest in peace, corporate cash, because it's dead to you if you're not deploying it in some way. Of course, if you have too much capital in your corporation, then you're going to need to worry about, I don't think you should need to worry, but you're definitely going to be worried about not being able to use your lifetime capital gains exemption. This is almost $900,000. Now, how does that work? If you watch this video up here, there's a really in-depth coverage about how you might be losing your lifetime capital gains exemption, but basically the way the rule works is 90% of your capital in your corporation should be used to produce business. So you can have 10% cash sitting in your corporation not being used to fund your business operations. The moment you exceed that 10%, that's when you can become offside for using your lifetime capital gains exemption. So just storing cash in your corporation is not a good idea. Of course, the other alternative is to take money out of the business, pay yourself personally, and that is the one thing you're trying to avoid. That's the whole point of having not the whole point of having a corporation, but just how you mitigate tax is having a corporation. Pulling it out personally and paying yourself a high income tax is not an ideal situation as well. So is there a different alternative? That's what we're going to look into right now. It's an elegant solution of how to use your capital in a different way. So this is called an immediate financing arrangement, or IFA. If you've heard of IFA, it's the same thing. Immediate financial arrangement. So basically what does that mean? Sort of a definition. It's taking the cash that you take from your corporation and you deposit it into a whole life insurance policy, and then you take that cash that's in your whole life insurance policy and you use it as collateral for a line of credit. Very simple. Taking money that you would otherwise have to pay income tax on to give it to yourself, you're going to put it into a life insurance policy that is owned by your corporation, and then you take that money out as a line of credit. It's ingenious. You don't pay any income tax on it. It's awesome. Pay attention to the video above that I've linked, because it goes into great detail. But let's look at how this might work. Basically, when you're using an IFA, you're freeing up assets or cash that's trapped on your balance sheet. You're trying to figure out how to deploy that capital in a way where it's not going to increase your tax base, it's not going to create an offside issue for your lifetime capital gains exemption, and it's not going to also burden you with a personal income, increasing your personal income tax. So this is an awesome strategy. It alleviates all of these burdens, and you're able to deploy your capital in your company in a very efficient and very effective way. And I think this is an important way for us to sort of set that up, because that if you had an idea of how to use your capital, you would have done it. But you're sitting on cash thinking, how do I use this money without having to crush myself with taxation? So let's look at an example. David and Vicky's company has $1 million in cash, and they decide they're going to buy some real estate with it. So they buy some real estate. Of course, I'm just using this apartment building as an example because it's a nice picture. Obviously, they're not buying this apartment building for $1 million. Just set that aside for now. So now they've gone ahead and they've taken capital from their company and they've bought a building with it. So all they've really done is they've traded asset classes. Cash for real estate. Still, it's not a bad idea, but now you've got this beautiful building. Now, is there a different way to do this? There is, because what's happened is in doing that, they have no cash anymore, but they have a building. So what you're going to do is you're going to take the same capital that you would have used to buy the building, you're going to put that into life insurance over a 10-year period. So think of $100,000 per year into a whole life insurance policy, and that's over a 10-year period. And then what you're going to do is you're going to borrow that money back from your life insurance policy to purchase the building. So it's just going in and coming right back out again in the form of a line of credit. It's not after 10 years, it's the next year. Depends on which company you use to do the line of credit. Some companies want you to wait until the next year when your second premium goes in. Some companies allow you to do it almost right away. And there's some pluses and minuses with each company in terms of what it would cost for the line of credit, that kind of thing. But essentially, you're putting the deposit into your life insurance and you're borrowing it right back. 100% of it, borrowing it right back and putting it into purchasing the real estate. That same building you were going to buy anyway, but now you've got two asset classes working for you for the price of one. You've got the whole life insurance policy and you've got the real estate that you wanted to buy. Now, the beautiful thing about this, let's just summarize this. The beautiful thing about this is having two asset classes for the price of one, but it's very strategic. I like the way this is being done. So you have a $1 million investment value in your whole life insurance. You've got a $1 million commercial real estate property. You've got the growth of both assets, and you've got now a tax solution. So think of both of those asset classes are going up. Now let's summarize. If you haven't watched the other videos on whole life insurance, you can look up there. You'll see a great video on that. Money that you've invested inside of a life insurance policy, whole life insurance policy, is tax exempt. You don't pay any income tax on the growth of that. That's the beautiful thing. So if you are a business owner, or if you're not a business owner and you're an individual and you have a large non-registered asset class, so let's say you've downsized your home and you've got now a big pool of non-registered income or non-registered asset, but you're paying income tax on it every year. So what you could do is you could just trade that for part of it every year into life insurance, and the growth of that is sheltered. You don't pay any income tax on it. And there's a whole video on how to take that money out without paying any income tax. So the other beautiful thing about this is that as that building goes up in value, you're going to have a capital gains issue. And you've got the life insurance now to pay the capital gains at your passing. The next thing is estate planning. You know, if you're going to be buying real estate, you ought to have life insurance to offset the capital gains you're going to experience so that you can pass on those assets to your beneficiaries without having to worry about CRA, Canada Revenue Agency. One of the things that I've noticed in the 20 years of doing these financial planning for clients, and that is when it comes time to pass assets to their beneficiaries without doing proper estate planning, their estate has a lot of tax. And so what usually happens is they have to liquidate an asset to pay the capital gain, the taxes owing on the estate, just so that the rest of the assets can flow through the beneficiaries on a tax-free basis. If you had a substantial life insurance policy, death benefit, that would take care of that. And you're paying 20 cents in the dollar as compared to your after-tax dollars paying for that tax. The death benefit amount will pay the loan that you have for your life insurance. So remember, the strategy is you deposit the money into your life insurance policy, you take 100% back that money as a line of credit. So now you've got two things. You've got cash growing inside a life insurance policy, and you also have the loan on the books as well. And you may or may only be paying the interest on it. And you can also have it where you can capitalize the interest and you don't pay the interest, you just let it grow. In any case, what happens is when you pass away, the death benefit of the life insurance policy pays off the loan and the excess amount goes to the beneficiaries on a tax-free basis. So it's an awesome product. You're doing With the same amount of money, you're able to do two things at the same time. And the option to repay the loan anytime you like. So it's not that you're locked in. In fact, if you wanted to pay off part of it or all of it, it's up to you. You can do that as you're going forward. That is how you can acquire two assets for the price of one. It's an ingenious thing for you to be able to do. Now let's do a few minutes, or at least a minute, on understanding a couple of things before you get all excited. So 3 reasons why you'd want to consider it. You get more assets working for you. It's a low risk investment. When you think about life insurance, without getting into, because I said I'm not going to get into how life insurance is actually the dividend that you receive each year. I'm not going to get into how that works. But life insurance companies, and on their nature, invest conservatively. So you have a very conservative investment producing a dividend to you that goes into your life insurance on an annual basis, and you don't pay any income tax for it. And so if you're low risk, or a portion of your investment strategy is low risk, then life insurance definitely fits into that part of your strategy. And it reduces the taxes now and through your retirement. So this is a very important consideration. And in fact, what we've seen, especially over during COVID, since 2020, we've seen a lot of business owners shift their practice from just doing traditional loans and using cash values in their life insurance policy as collateral to do these types of investment strategies, because they recognize that they need life insurance, and they also recognize that they want to grow their asset base. So we're seeing this on a more frequent basis. Business owners go this strategy now because it's being able to use your money in a more efficient way. Now, IFAs are not for everyone. So let's examine why. Well, you have to be insurable. You have to be in good health. If you're not in good health, the cost of doing the insurance, I don't want to say outweighs the benefit, because there's still a tremendous benefit here for you to take money from your corporation without paying tax and to fund another asset. And then you have 2 assets growing for the price of one. Still a good value. But if you are uninsurable, you can't do this kind of policy. You have to have solid, sustainable cash flow. Unlike doing, let's say, an RSP contribution where you could stop and start, you could vary the deposit amounts. When you do the life insurance strategy, it's very much akin to having a mortgage. You have to do that payment every single year. And if you stop doing that payment, at least early in, then you could be in jeopardy of having that policy terminate on you. So it's really important that you have solid, sustainable cash flow in order to do this kind of strategy, at least for 10 years. And then this is advanced financial planning. I don't suggest anyone do this without actually talking with someone like me, an advisor, and going through advanced financial planning. That means having a written financial plan, but more than just time value of money and will I have enough money to retire. We're really talking about tax tables, what your goals are for using capital, what your needs are for capital going forward, how this might affect your ability to borrow in the future if you have any future expansions or a need for more capital, what taxation might be like for you, and what your retirement goals are. So I would have all of those things mapped out before you do any strategy like this, because it is a commitment for the next 10 years. Well, everybody, that's all I have for you today. I hope you enjoyed this. If you found a lot of value in that, please hit the subscribe button and the like button. Hit that bell so you get notified when I upload another video. I do videos, about 2 videos per week, plus a live stream every Wednesday at 7 o'clock. And I hope you enjoy this video. If you have any questions, put your comments and questions down below. Please share this with anyone that you think would need to see this. I always like to tell people we take care of your wealth management so you can take care of what's most important to you. I believe in that so much so. I think it's important that you value your relationships and the people around you more so than your money, and leave that to someone like me or to other professionals so that you can enjoy those relationships. Here's my contact information below. If you want to reach out to me, you can hit the links in the YouTube channel. That'll take you right to so many different areas, whether it's my website, email addresses, other social media accounts. Pretty easy to find. Thanks again for taking time out of your day to watch this video, and I hope to see you again in the next video. Thanks very much. Take care.